Hi, my name is Mike Resnick, and I'm an associate in the tax department at Sutherland. I'm joined today by a partner in the tax department, McElroy. We look forward to discussing with you methods of accounting and providing a brief overview of what they are, what methods are not, and the significance of these methods.
We thought it would be helpful today to talk a little bit about tax accounting. Tax accounting looks at both character, that is whether items of income and expense are reported, and how those determinations are made. But an important part of tax accounting is methods of accounting, and methods focus more on when items of income or items of expense are taken into account. Invariably, when a company is thinking about a method of accounting, it's because they want to change their method of accounting. And you may want to change a method of accounting to achieve more favorable results. Taxpayers invariably make changes so that they can either accelerate when deductions are taken into account or defer when income is reported. Methods of accounting are present in virtually every business and can have very significant financial consequences. Let's turn now and talk about what is a method of accounting.
And that's a very good question, Ellen. For decades, that's a question that the service has actually struggled to pinpoint an exact definition for. But fortunately, with decades of case law, the courts have created three hallmarks that kind of define a method of accounting. First and foremost, a method of accounting needs to be consistent. This consistency is a practice of recognizing income or taking a deduction that the taxpayer has done generally for 2 to 3 years, and the IRS recognizes a practice after 2 years of being a method of accounting. A second major hallmark of methods of accounting is certainty. And by certainty, what the courts and the IRS have looked to is the predictability of results. They want to ensure that if both the IRS and the taxpayer perform this method, the same result is achieved. The third hallmark of method of accounting, and what many consider one of the most important, is timing. And when we speak of timing, we mean not whether an item of income is being recognized or deduction is taken, but when that item of income is recognized and when the deduction is taken.
That's right, and timing can have a really important effect with respect to a taxpayer's overall tax position. It's important to know what's a method of accounting, but it's also important to think about what's not a method of accounting, because strategically it may be better to argue that something's not a method of accounting. Typical examples are shown on the slide, but the first is errors. Errors happen invariably when returns are prepared, and that can be with respect to computational mistakes or other items that are erroneously included in a tax return. It can also involve any change in characterization. Further, it can be a change in how a taxpayer does estimates. These are all typically thought of as not methods of accounting. One of the most important things to think about in looking at what is not a method of accounting is a change in underlying facts. Frequently, a company can change when an item of income or expense is taken into account by changing either its contractual relationships or a change in business practices. One of these may be easier to accomplish in a particular circumstance than changing a method of accounting, but may in fact have the same result. Methods of accounting are significant in a number of ways.
Exactly. And huge benefit of methods of accounting are that they allow taxpayers to go back into closed years and make changes to income recognition or deductions that they might have missed taking in previous tax returns. Normally, when a taxpayer files a tax return after the statute of limitations has passed, if a deduction opportunity has passed, they no longer can take it. With a method of accounting, they're able to look back into those closed years and make such changes.
Unfortunately, of course, the IRS can do the same thing. And it's not that they're actually going into the back years and changing things, but when you change your method of accounting through an adjustment that you make, you're able to have the same effect as changing the item in the closed years. The greatest benefit, of course, of a method of accounting is audit protection. And what audit protection means is that when you change your method of accounting, the service is prevented in an IRS exam setting from coming in and changing that same item. So it can be quite beneficial.
Exactly. Thank you so much for joining us today in this conversation about methods of accounting. For more information, please feel free to contact either of us. And for more bottom line videos, please access Sutherland.com.